Big question going into payrolls. What on earth do you do with that payrolls report? Top line really strong, the rest of it not so much. Equity futures positive, dancing higher by 0.66% on the S&P. The Russell outperforming. The big cap tech story continues for a sixth consecutive week. Looking for another weekly gain. As the price action in equity, switch up the board and get to the bond market. Yields a little bit higher by a couple of basis points on a 10-year maturity. Back through 360. The bigger move at the front end on a 2-year. All over the place post payrolls, but higher now by 5 or 6 basis points, just short of 440. A touch of dollar strength briefly. It fades. The euro just about unchanged against the dollar. Euro dollar 107.69 and crude higher by 2.5%. Commodities up today off the back of speculation that we get some stimulus from China and reporting from the team here at Bloomberg that maybe China is considering doing something around the property market to support things just a little bit more. 30 seconds into the session, the broader equity market opens higher by almost 0.7% on the S&P. On the Nasdaq up by 0.8%. One stock to watch at the open, Lulu, topping Q1 earnings estimates and delivering a better than expected outlook. The CFO saying this: a meaningful acceleration in our China sales coupled with lower freight costs contributed to our better than planned performance. Abby has more. Hey, Abby.
Hey, John. Well, after 9 down days in a row, Lululemon, that was the longest losing streak for the stock going back to 2016. It is now up more than 15%. Its best day since June of 2018, and it has everything to do with that China strength that you were just talking about that allowed them to beat adjusted earnings by 16%. Sales were better by 4%. As you mentioned, they raised the full year outlook. A lot of it having to do with that China strength. It also has to do with the fact that they're finally moving through their bloated inventories. They rose just 24% from a year ago in the first quarter when they were up 50% year over year. Gross margins expanded. Executives at the company are saying that has a lot to do with China. They're also planning on opening 30 to 35 stores, many of them in China. So that China rebound that everybody's been waiting for, at least it's there for Lululemon. And it's interesting, John, because retail has been so mixed this year. This is another one of the brands, the higher end brands that retail consumers seem to be flocking toward. They're fashion right and being willing to pay up for this brand. Again, this stock right now up about 15%.
Abby, never mind this year, the last 24 hours. Just a story of contradictions. And Abby, thank you. Abby looking at Lulu there, absolutely fine, flying. Nordstrom just about holding on. Macy's terrible. Dollar Tree telling you an ugly picture for the US consumer right now, and retail all over the place. Lulu right now up by close to 15%. Want to talk about the banks, the financials. Goldman warning of a 25% decline in trading revenue for the second quarter. The President John Waldron saying, quote, it feels like we're going to have a contractionary environment for a period of time. We're now embarking on additional targeted action with headcount. Kaylee has more. Hey, Kaylee.
Hey, John. Well, interesting to see Goldman actually positive here at the opening bell by about 0.4%. But we have to keep in mind the week through yesterday's close, it was down about 4.7%. So this rebound isn't likely to end in a weekly gain for this company. Of course, earlier in the week, we did get reports from here at Bloomberg that Goldman is looking at another round of job cuts, less than 250 jobs this time around. But that's after they cut 3,200 back at the beginning of the year and several hundred last fall. So the third round of cuts in less than a year, as they are contending not just with a 25% slump in the trading business, but other areas as well. Waldron talking about sluggish capital markets activity, the slowdown in deal making that is weighing on investment banking fees as the macroeconomic environment is just more difficult. And we heard echoes of this from Morgan Stanley as well. The co-president, Andy Saperstein, speaking on Wednesday, also said he expects that this quarter will be down year over year, that sales and trading is softer. Investment banking is very challenged, and the industry has been what he described as a sustained trough since last year in investment banking. For Bank of America, though, John, the story is a bit different. We heard from Brian Moynihan, the bank's CEO, yesterday, saying that he expects trading and sales activity to be flattish this quarter. We have to keep in mind, though, that Bank of America is coming from a bit of a different base because it didn't have quite the performance in that division last year as some of the rivals did.
The bank's doing better today. Kelly, for the wrap there. Thank you. Down in Washington, D.C. Nothing defensive about this equity market this morning. The underperformance from utilities, healthcare, the outperformance from materials, consumer discretionary, energy. There's a bit of an attacking pose to this equity market right now, up by 0.9%, even with the yields drifting higher at the front end by 6 basis points back through 440 on a 2-year. The slowdown weighing on earnings from Dow, though, feeling the pressure from weaker consumer PCE PC demand. The company delivering a tepid outlook despite topping Q1 estimates. The stock just about positive. Katie has more. Hey, Katie.
Hey, John. Well, it wasn't as bad as feared, but it still wasn't good. We know that personal computers have been a tough sell. We saw that from HP earlier in the week. We saw it again from Dell today. So let's get specific here. Consumer PC sales plunged 42% in the period ended May 5th to about $2.12 billion. Analysts had been looking for about $2.3 billion. They did fare slightly better when it comes to commercial PCs. That segment brought in about $9.9 billion of sales, which was an 18% decline, but it still beat estimates. It was the outlook, though, that was lukewarm at best. Dell sees revenue between $20.2 billion to $21.2 billion in this current period. Now, on average, analysts had been looking for about $21.1 billion, so at the upper end of Dell's range. You look at what the stock is doing, and it's interesting. It had been lower pre-market. It's bouncing around right now, currently up about 0.5% or so.
Katie, thank you. I'll show you a bigger move than that. Year to date, and Katie, thanks again. Year to date, Apple up by close to 40%. Shares of Apple inching ever closer to an all-time high. We've got two analysts raising their price targets today ahead of next week's developers conference. Morgan Stanley writing this: the combination of technological improvements and lower price points of the AR/VR headsets is what could make a conference a more significant stock catalyst this year. That stock up just a bit, 181, up by 0.6%. Want to stick on tech? Here's a story for you, buried by the news around the payrolls report in the last hour, but what a story. Bloomberg learning that Amazon has been in talks to offer mobile service to its Prime members in the United States. The report sending Amazon higher and telecoms lower. Ed Ludlow on that breaking news of the last hour or so. Morning, Ed.
Yeah, John, there's a lot to cover here. These are some pretty monster moves in reaction to this Bloomberg reporting. According to sources, Amazon is in talks with Verizon, T-Mobile and Dish. The idea, according to sources, is to get access to wholesale prices and then offer a low price, $10 per month, or for free to Prime members to give access to a wireless network. You look at Amazon, up 2.3%, but I think we better take a quick look at the networks themselves, the carriers themselves. Dish is up now the most since 2011 at one point, up 19%. The idea is that, according to sources, it would give higher utilization for these newly built 5G networks. Whenever Amazon enters a new product category, it sends shivers into that industry. And you look at the reaction to the downside, Verizon, AT&T and T-Mobile. T-Mobile down 7.6%. That is the biggest drop since March of 2020 on that particular stock. The reasoning being that Amazon can undercut pricing because of its flex financially. So really interesting to see what this means for Prime, but also the future of those carriers.
Fascinating story. Ed, thanks for that. No doubt you and Caroline Hyde will be talking about this a little bit later on Bloomberg Technology. Look out for that in about 2 hours and 20 minutes time on Bloomberg TV. Amazon is doing okay. Dish Network's flying. The rest of the telecoms, it's not looking good out there at all. For the broader market, it's looking okay, better than okay, up 1% on the S&P 500. I mentioned there's so much going on right now, away from the payrolls report. You've got the China stimulus story, which we can talk about right now. Bank of America's Michael Hartnett writing the following this morning. The tech stocks have discounted a June Fed pause, leaving China stimulus as the bullish June surprise. He says the contrarian call here right now is to buy the Hang Seng and sell AI. Think about the beaten up parts of this market, commodities, EM, resources and banks. And right on cue this morning, China is said to be considering a new package of measures to boost its economy and support the property market. That's one we'll be talking about going through the weekend. For us right now, we get lucky again. Joining us is iCapital's Anastasia Amoroso alongside PGIM's Mike Collins. Anastasia, you get lucky too because you've had about an hour to think about this labour market report because everyone else is still confused by it. What's your take on it?
Well, look, I don't think the report is really as buoyant as the payrolls number actually suggests, because when you look at the household survey, and I do focus on this one a little bit more in this particular report, it is a more expansive measure that takes into account the self-employed people and household workers. And, you know, if you look at that, you do see a little bit of weakness or at least loosening up in the labor market that's emerging. So I think the Fed is going to focus on that. The Fed is going to focus on the fact that wage growth is running a little bit slower this time time around than it did the month before. So I actually think that's a positive, and that's how the markets is certainly interpreting in this. I will say the Fed also has plenty of reasons to keep on hiking rates because the data, the economic surprise continues to be so resilient. But in a way, they've sort of pre-committed to a pause. And I think given, again, the weakness in the 3.7% unemployment rate, I think they can have enough credibility to pause in June.
Mike Collins, is so confusing. The labour market data at the very headline, payrolls growth this morning, together with claims earlier this week, job openings earlier this week, says there's nothing to see here, no problem. Then you go to the retailers and they're screaming, we've got a discretionary recession. Mike, which one is it?
Yeah, it's a lot of churn, Jonathan, and as Rick Reeder said, a lot of dispersion between winners and losers, not just in corporations, but among people, right? You are seeing that lower income bracket, as Mike McKee reported, African-American unemployment rate is jumping. You're seeing more distressed and highly levered companies really suffer in this environment. So that's something that everybody, including the Fed, really has to keep an eye on. But our base case, when you see this volatility of numbers and it's really difficult to parse them, you step back, say, where are we heading in the big picture? And the base case is that, growth is moderating. We're probably going to be running at 1% GDP in this country over the next 12 months. Inflation is moderating. We'll probably be running at a 3% inflation rate over the next 12 months. You add those together, you get 4% nominal GDP. That's not a world where the funds rate should be 5, nevertheless 6. I think to talk about taking it to 6 is kind of crazy. The markets, as you know, are pricing in one more full hike over the summer. And then kind of remarkably, 200 basis points of cuts from there pretty quickly over the next 17 months or so. So that's a real aggressive set of cuts, maybe overdone.
The environment you described, Mike, sounds like by the NASDAQ 100. The NASDAQ 100 year to date is up by 33%. It's just a phenomenal rally. Anastasia, you've been constructive on tech, you've been constructive on this market. I remember several payrolls reports ago, you talked about breaking out of this tight trading range of 23 to the upside. Anastasia, we've done that. Can you make the argument now with conviction that now is the time to lock in some profits here?
Look, I think in parts of the market, it is absolutely the time to lock in partial profits. And in particular, I am looking at the NASDAQ. I'm looking at the semiconductors. I mean, the rally in semiconductor stocks, for example, has been stunning year to date. It's up 65%. And especially in the last couple of weeks, the semiconductor space has gone parabolic, which we all understand why, because semis are the key enabling technology of artificial intelligence. But anytime you see something move to the upside so far, so fast, so parabolic, you get into an overbought territory, and that's exactly where we are today. And then also, John, I look at the valuations of the semiconductor stocks, and the SOX index, for example, the valuation expanded from 13 times multiple at the October lows of last year to 28 times today. And don't get me wrong, I'm a huge believer in the semiconductor story and the artificial intelligence story, but if I take a tactical investor perspective near term, that's a sector that's looking stretched on positioning, on valuation, on technicals. And so for those reasons, I would want to take profits. And by the way, when you have this setup, you always are waiting for some sort of a negative catalyst. And we don't know which way the Fed is going to move in June, but I think there is scope for a hawkish surprise given how resilient the data has been. So if we have to reprice the path of Fed policy higher, then I think that's the ultimate negative catalyst for semiconductors. By the way, if
for that debate,
I want to buy it.
As you know, CPI on June 13th. Mike Collins, if we do leave these growthier parts of the equity market tagged, you've got to make a decision whether you want to go back into the cyclical trade again. Mike, the cyclical trade just seems to have broken down. China disappointing, Europe disappointing. We reported earlier this morning that China might be considering stimulus measures. Mike, what gets that cyclical trade going again?
The Fed pausing for sure, not only skipping, but kind of signaling eventually, maybe over the next few months, that they really are done or really close to done. And the market's pricing of all these cuts have to continue to be in place, right? If the whole yield curve elevates higher toward that 5.25 funds rate, there's more pain to come, right? Multiples will compress, credit spreads will widen, the economy will weaken. So these cuts that are priced in may be aggressive in the near term, but wow, they have to really be sustained there for the economy to continue running.
Mike Collins is going to stick with us alongside Anastasia Amoroso. Coming up, the Fed's last word before going quiet.
We're getting close to a point where we can sit for a little bit. We really should skip, not pause. I don't like the word pause.
That conversation up next with Anastasia Amoroso and Mike Collins.
We're getting close to a point where we can sit for a little bit in terms of policy. I don't know if we're exactly there yet, but I am in the camp increasingly coming into this meeting of thinking that we really should skip, not pause. I don't like the word pause, but skip an increase.
The committee of the Federal Reserve found a consensus on at least one thing. Don't call it a pause. Call it a skip. Governor Jefferson leading the way this week. Skipping a rate hike at a coming meeting would allow the committee to see more data before making decisions about the extent of additional policy firming. President Harker backing him up in many ways. We should at least skip this meeting in terms of an increase. We can let some of these things resolve themselves, at least to the extent they can, before we consider at all another increase. Federal Reserve officials getting in the last word ahead of the quiet period going into the next decision in just under 2 weeks away. Anastasia Amoroso, Mike Collins back with us. Anastasia, you mentioned this, and forgive me for jumping in a little bit prematurely, with regards to the Fed's next move. Morgan Stanley's Ellen Zentner saying this after the payrolls report: we do not believe today's report was strong enough to meet the bar for the Fed to hike in June, but it raises the risk that the Fed could hike in July. Anastasia, is that the way you're thinking about it too?
I think that's the scenario, John. I mean, if the Fed didn't really pre-commit, if the Fed didn't really make all the statements about the potential to have the leeway to pause, I think they would probably go in June. But, first of all, it's still only been a couple of months since the banking turmoil, and it's really just subsided in the last month or so. Second, the data has been somewhat mixed. So I think that does give the Fed some flexibility. But the main point is that Powell really said pretty strongly, saying we have the luxury to wait given how much we've tightened already. And I think they're likely to use that luxury. And here's the thing, John, we've had the Fed who went from hiking 75 basis points to hiking 25 basis points. But the next part of the tightening cycle may be that they maybe hike once a quarter. And, if that's the case, then, July might as well make sense.
We spoke to Mohammed in the last 50 minutes or so. Take a listen to what he had to say about the Fed's next move.
63.
We also know that the U.S. economy is increasingly dualistic between what's happening in manufacturing in general and what's happening in services. And all this, including today's job reports, complicates the Fed's policy challenge. Whether you call it a skip, a pause, or hike, it certainly complicates it.
And Mike Collins, it makes it complicated for all of us. Mohammed mentioned what was happening beneath the surface of the economy. Manufacturing is screaming cut rates, services screaming you could stay where you are, maybe even hike. Mike, what are you meant to do with that information? How much weight do you put on each?
Yeah, it's really tough, right? And the markets are kind of right in the middle. They're pricing in about half of the hike in June and the other half in July. So they're pricing in one more hike for the cycle, which feels about right. It's hard to argue against that. But again, by the time, if they do skip in June, Jonathan, by the time the meeting in July, which is almost 2 months from now, our best guess is that you will continue to see more evidence that growth and inflation are moderating, and the Fed will probably be done for the cycle if they skip in June, would be my guess. And remember, you have to take all of the hikes into account, not just at the Fed, but globally. You add all the rate hikes around the world, Jonathan, over the last couple of years, it is multiples of anything we've seen in our lives. You add quantitative tightening, and as Anastasia said, the bank lending standards tightening pretty significantly. All that points to the funds rate is as high as it should go for the cycle.
I said this a little bit earlier. There's nothing boring about it right now. That's for sure, trying to work out all this stuff. Mike Collins, Anastasia Amoroso, to the two of you, thank you. Just always a stellar lineup on Payrolls Friday, and appreciate your time, as always, too. The equity market on the S&P 500, positive by 0.8%. The Nasdaq positive as well. The Russell doing nicely. And the bond market yields were higher off the back of the report, higher again by 9 basis points at the moment, 443 on a 2-year. Further down the curve, 10-year maturity yields up there by 5 to about 365. Let's get you some sector price action. Here's Abby.
A solid rally for the S&P 500 indeed, John. In fact, the index is heading to its third up week in a row, the longest weekly winning streak since March. As for today, not surprisingly, with the strength, we have most sectors higher. In fact, we have 6 of them higher by more than 1%. Materials and energy, the top sectors, up about 2% or more. All the stocks in each of those sectors are higher. That's the kind of strength we're seeing today. As for the AI rally, it is strongly in place over the last 2 weeks. It's interesting, though, John. Earlier, NVIDIA had crossed the mark to $1 trillion market cap. Again, that stock now down. But over the last 2 weeks, you can see that tech, the stocks, NVIDIA and C3 AI, all on fire as the AI craze continues.
Over the last 6 weeks, Nasdaq 100, 6th weekly gain, longest weekly winning streak going back to July 2021. Abby, thank you. Up next on this program, we'll get you to the weekend. We'll take a look at the trading diary into the weekend and beyond. Equities positive on the S&P 500, up again on the Nasdaq. Connor Russell doing nicely here. Going into the weekend and beyond, let's get to the trading diary. It looks a little something like this. President Biden speaks at 7 p.m. Eastern time about avoiding a default. OPEC Plus meeting in Vienna over the weekend. We get U.S. durable goods and ISM services numbers on Monday, plus Apple hosting its Worldwide Developers Conference as well. The UK Prime Minister Rishi Sunak visiting President Biden in Washington on Wednesday. And finally, got another round of jobless claims coming up on Thursday. Just a programming note, on Tuesday I'll be flying out from the East Coast to the West Coast and catching up with good people over at PIMCO. Manny Roman, Dan Iverson, fantastic lineup. Some of the best people out there, including the former Fed Vice Chair Rich Clarida as well, Tiffany Wilding, all of the above. You think of the name? They're going to be with us on Tuesday on the West Coast live from California. I'll see you then.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Friday, June 2nd. Here are the top market stories that we are following for you at this hour. A whopper jobs report. The job number crushes estimates again. While the unemployment rate rises, wages moderate. We're going to speak to Heather Boucher of the Council of Economic Advisors. And pretty much something for everyone. Yields soar and equities rally. Markets tentatively price in one more hike by July. And monopolistic tech. BofA says the tech trade wins through pricing power and squeezing smaller suppliers, while Apple nears a record high. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, dare I say Goldilocks? Dare I say that from the jobs number?
Well, yes and no. As you say, there's something in there for everybody. Is it too hot? Is it too cold? It depends on which number you want to look at. The real question is how the Fed's going to read this. We're going into the blackout period, so we're not going to know until we actually get the decision. They've got us comfortable with skip. They've got us there. The market was okay with it, and then we get this piece of data. We're going to get services ISM next week. We're going to get CPI next week. But I think there's something in here for everyone, as you say. Strong headline number, Alex, but that unemployment number creeps higher.
Yeah, and also the wages number comes down. So yeah, we're still growing up by 0.3, but it's lower than what we were kind of lower than what we were used to. So there are some details to kind of dig in on that.
Yeah, I think the Fed's got a real communication challenge right now. What does it do? How does it deal with this? If you get two more strong pieces of data, CPI is hot, let's say this services sector, and there's evidence within this report that the service sector could be hot, then what do they do with that? So that takes us to our question of the day, which is kind of an evolution of the question we asked yesterday. Should the Fed now skip June? Pricing is starting to move in June's favor. We've moved significantly in that direction, but we're still not there yet. And July looks like a racing certainty at this point. So let's kick it around a little bit. Liz McCormick, Mike McKee join us to try and answer the question. Mike, it is the 14th straight month in which we have beaten the median estimate. Yet the unemployment number ticks higher. Is that tick higher in the unemployment number going to be enough to favor July over June?
By itself, no. It's an interesting number because when you do the calculation to reconcile the household survey to the establishment survey, it turns out you get about 220,000 jobs created in the household survey. So there are some statistical issues between the two that would seem to resolve on the side of the, what did you call it, Alex? A Whopper jobs report.
I did.
So I don't think it's going to make a big difference to the Fed. Probably more to the politicians in Washington who will either criticize or praise this report. The wages numbers is interesting as well because it was up 0.3. The prior month had been 5, revised down to 4, and all the previous months this year had been 3. So really we're sort of still on trend. Wage growth didn't significantly slow. What we're seeing is wage growth largely in the lower paid industries, and so on a percentage basis you're getting a lot, but does it move the Fed? That's going to be the question.
Yeah, so Liz, I mean the market's sort of inching towards moving the Fed. What's it telling us? Skip the June?
Yeah, exactly. And I think what Guy said at the top of the hour kind of nailed it, is that inner circle of the Fed got the market convinced, like, oh, there's a real, the higher ups want to pause, right, and look at the data. And I think this data, like Mike was saying, it's a mixed bag, different things, but it's enough for the market to lean heavier into July, and that's what they're doing. There's, pretty certainty that at least by the end of the July meeting, the Fed has hiked another quarter point. June, not so much.
But Liz, if we get a strong CPI print, you get services ISM coming through strong. The Fed's boxed itself into a corner here, hasn't it? As I say, the market was getting comfortable with skip. We all like the idea, apart from Alex, of course. We all like the idea of the skip. But now that skip is being questioned.
Well, right. I think, and, Powell's always made clear we're data dependent, that I think that, they do like a consensus. So I think if ISM services is strong and that CPI report, which they get on the first day of their meeting, is I want to say uber high, it's definitely, if it beats, decisively on the upside, they might not be able to cajole the hawks and say, let's skip. So I don't think we're writing it off. There's about 9 basis points maybe priced in for June, so it's not 0. But I think you're right. And if we were looking at what's the market going to trade off in the blackout period, it's going to be angst around all this data. So you're right. We can, and somebody was saying earlier, it's so true, I'm scratching my head. It just seemed like yesterday we were pricing over 70% odds of a June hike. Then it went down to 20.
Yeah.
It's all over the place.
Yeah, well, to that point, Guy, just a few weeks ago, we were pricing in 3 cuts for this year. Now we're barely at 1. So you have to, I wonder if the question is better, is this data enough to continue to price out cuts? And does that kind of help the market do its job?
Well, I think we've already, we're there now on that. We basically skipped over the debt ceiling.
But are we? Because if we price out the recession even more, we're still pricing in a cut for this year. If the recession goes out, does that change the calculus?
I think end of this year, beginning of next year seems to be the kind of the sense right now. How high do we need to get in the meantime, I think, is a question that we still don't know the answer to. One more, two more, that seems to be kind of where we are increasingly. But I think you're going to get a lot of oscillation. You're at the peak of the cycle, Mike McKee. How difficult are the data for the Fed to interpret at the moment? What is the real takeaway from this number? Is it one piece of data, or is it actually part of a series of data that we are watching? I throw in here the JOLTS number, I throw in all the labor market, the ADP number, all of the labor market data that we're looking at the moment. They all seem to be pointing in the direction of a strong labor market. Is that the trend? Has the Fed got it wrong, basically?
Well, I don't think the Fed's got it wrong. The Fed has been arguing through all this tightening cycle that the labor market is very tight. And all of the data that we've gotten, with the exception of this unemployment rate oddity, is backs up that idea that the labor market is very tight, that the hiring continues, there's still a lot of job openings, and companies are paying up to get workers. So that story is still in place. The issue is going to be, does it create inflation? Do we get away from inflation and still have a strong labor market? That's where we'll look to the CPI report that's coming out and other inflation indicators going forward. We had that big drop in the ISM manufacturing prices paid index yesterday. Does that continue into other indicators? That's how the Fed's going to make a decision. I sort of agree with Liz that the sort of troika leadership of the Fed has suggested that they want to hold, skip, pause, whatever, but not move in June, put it that way. So I think there's nothing in here that's going to compel them to change their mind. But if they do get a strong CPI report, they could. It is, Guy, as you said, a communications challenge.
Which then, then puts July much more in play. I'm looking at the bond market, Liz. The front end now up by about 11 basis points. How much in the short term do you think there is to this move?
Well, it's funny. It was up 11, and then it kind of came back. I think the bond market was trying to figure this out, but like you said, it's kind of plowed back up. So I think for the bond market, what's clear, what seems clear, is the Fed is likely not done. Now we're duking out, when does it come? Probably not June, maybe July, but I think they're not done. And Alex, I think your point earlier was very smart about the cuts, because I've seen a few investor notes since the payrolls came out saying it's kind of murky, but a lot of them are ending with, what's clear is the Fed is not cutting anytime soon, not this year. So people are kind of saying, well, let's at least forget, even though the market's still priced for maybe a quarter point cut by the end of the year, but that's not much compared to what it was.
Liz, what would Volcker make of this data?
Oh God, I don't know.
I guess the question I'm really asking is, are we in danger of calling the piece too early? We keep getting confounded that the economy is stronger than we anticipate, that if we do pause, if we do, dare I say it, cut at any point, that the economy is going to make fools of us all once again, in the same way that Burns got made a fool of and Volcker had to fix. Are we heading in that similar sort of direction, that we pause, we have a look, and then that pause actually compounds the problem and inflation reaccelerates?
Yeah, and I think, not to give away my secrets, but I have, I talked to a former Fed person who was saying the same thing, that this was a hard-fought credibility the Fed kind of gained to say, yeah, we finally got on top of inflation, but it's very precarious. They could lose it easily, and I definitely, Chairman Powell likes Volcker. He wants to be Volcker, not Burns. So I think it's, I think in my physics days, it's kind of a tenuous equilibrium. So they can't afford to risk, kind of dropping the ball. So I think that's why they are they banish the word cut. They are never saying, yeah, there's a chance of a cut. They have to kind of retain this inflation fighting credibility.
Physics, yes. Guy just finished some physics homework, right? Or was it chemistry, Guy? Which one there?
We did physics before half term, yeah.
Okay.
We're on to chemistry now.
Got it. Okay, so he's all up on that.
Unstable bonds, yeah. We're the same sort of idea.
Cool. Okay. Thank you, guys. I really appreciate Liz McCormick and Michael McKee. It's a great setup for the next couple hours. So coming up, we're going to get more perspective on that question of the day. Should the Fed skip June? Lisa Erickson of U.S. Bank Wealth Management is going to join us next. This is Bloomberg.
given the data, they should hike. Okay, if they are true to their word, they should hike because they are data dependent and the data has been hotter than expected. The surprise index, John, is at levels we haven't seen for a very long time, pointing consistently to stronger than expected data. So if they are true to their word and true to their target, they should hike. I would not hike.
That was Bloomberg opinion columnist Mohamed El-Erian on Bloomberg TV earlier today. So our question of the day, should the Fed skip June? I want to bring in Lisa Erickson, U.S. Bank Wealth Management, Senior Vice President and Head of Public Markets Group. Okay, should they skip June? Is it July now?
Well, I think it's really, to your point, a tough question to answer, and really regardless of whether they decide to stand pat for now or whether they hike again, I think actually the more important issue is just how they communicate ongoing, because really the key message to the market needs to be we've come a long way in terms of where interest rates have headed, and we're committed to continuing to fight inflation. So even if we do decide to pause in June, again, we're going to continue to monitor basically how the data comes in to see how inflation progress continues to move forward.
How do you invest around that, Lisa? What do you do?
So we're really moderately cautious right now, and the primary reason is what we're talking about. We still have elevated levels of inflation, and with that, we're going to have not only the Fed, but central banks globally, whether it's the ECB or other central banks, really continuing to be biased towards keeping that monetary policy tight, and again, potentially even tightening a little bit more. So in light of that, you just have a tough situation where you do have higher interest rate trajectory, and then you have the lagged effect of what happened really in the past year. And at some point, we're going to continue to see that behavior both on consumers and companies.
But, Guy, what's interesting is that if these numbers continue to maybe push out the recession forecast, remember when the first quarter was going to be the really bad quarter of this year? If it pushes it out, that keeps growth going, and that keeps consumer spending, and it keeps things better, and that's going to create even more problems down the road, you have to wonder.
And the longer this goes on, the longer the whole cycle gets embedded, that It becomes a cycle. You get wages going up, you get inflation going up. We're going to talk to the White House, Heather Boushey, a little bit later on. We'll be asking her that question. I don't know, Alex, I think this is a really difficult moment for the markets to navigate. I look at equities higher today. In some ways, that's a bit of a head scratcher. Yields are up today. Mm-hmm. We've seen a tech-driven rally. What's going on? I'm confounded not only by the data, but by the way the market is reacting to it.
Well, Lisa, to that point, I was going to ask, does the number justify the rally that we're seeing right now?
Well, what I think really is going on this week is you just continue to have some positive reaction to the fact that things are not as bad perhaps as the market expected going back to the beginning of the year. Again, while we're seeing economic activity slow as well as corporate earnings come down, the numbers have come in, particularly on the company side, better than the market expected. And so you really have a response to somewhat of a revision standpoint there, as well as the fact that there is some positive relief rally really on the fact that we are making progress on that debt ceiling issue.
Lisa, at some point we are going to run out of steam. At some point the consumer presumably is going to stop spending. What happens then? As an investor, I probably don't have a 3-month horizon, a 6-month horizon, a 9-month horizon. As an investor, I probably have a longer-term horizon. How should I be thinking about what kind of recession we're going to get, given the longevity of this cycle that we're seeing at the moment, and the fact that we continue to all be surprised about how strong this economy is? It's strong now. Is it so strong that when the downturn comes, it's worse than we think it is? We think the economy is going to be worse now, but it's better. Does that mean it's going to be worse than we think it is on the way down?
Well, we're, again, moderately cautious. And while, again, to your point, Guy, there's a number of signals that would really point to continued headwinds for the consumer, which, as we know, is the largest share of the U.S. economy going forward. On the flip side, they really have been relatively resilient. And that's on the back of really that extra savings, a strong labor market, trends which continue to hold them in. And so all other things being equal, we see a little bit of two sides to the story. On the one one hand, again, there are headwinds, but again, they still have some going firepower to continue to maintain their spending and their income. And so we see, again, some reason for caution, but not really wanting to overdo it or go out on our ski tips on that, again, simply because they've really been able to do relatively well.
Yeah, which then begs the question, what do you do with AI, which is immune from kind of everything that we've just talked about, aside from having a pretty powerful rally? What do you do with it right now?
Well, certainly for investors with the longer term horizon, which we would define as more than a year, we certainly have an interest in the general technology sector, and AI is really one of the key reasons. If you think about what's going to facilitate artificial intelligence going forward, it really starts on the data side, whether it's data capture, data storage, data distribution, software and analytics, and that, of course, is the purview really of the tech sector. And so they've got that trend in addition to many other trends, people just continuing to demand anytime, anywhere access, cloud computing, e-commerce, all of those kinds of trends are continuing. And so we really see that longer term opportunity.
Lisa, great to see you. Thank you for joining us. We always appreciate your time. Lisa Erickson of US Bank Wealth Management. Alex, the real question remains, though, are we in a situation where these tech stocks are still rate sensitive? I don't know yet. How far rates ultimately are going to have to go, ultimately we'll test that theory. I don't know. I don't think we have figured that out yet. The AI thing is really confusing from that point of view.
Yeah, and clearly it hasn't been sensitive to the strong rally in yields over the last couple weeks. That would define maybe it is defensive then in a different kind of way. I don't know.
Yeah. Apple's on a tear. Look at what's happening there. Look at what's happening with NVIDIA. I know it's been bumpy over the last couple of days. Amazing to see what's happening. We need to talk about Amazon as well. Apparently, it might be getting into the telecommunications business. We're going to talk about that next. We're going to take you to San Francisco. It is time for the startup and the return of Ed Ludlow.
Great questions.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Lisa Mateo. Global food costs fell in May, dropping to the lowest level in 2 years. It's also reviving hopes that inflation on supermarket shelves will start to ease. A United Nations index of food commodity prices fell 2.6% in May as declines in grains, vegetable oil, and dairy offset gains in sugar and meat costs. Now, the gauge of prices for internationally traded agricultural commodities has fallen 22% from its peak last year following Russia's invasion of Ukraine. Novartis AG's Kisqali reduced the risk of tumors recurring by 25%. 9 out of 10 people who received the drug in addition to hormonal therapy after surgery were disease-free after 3 years, compared with 87% of those given just hormonal therapy. That's according to trial results presented today at the American Society of Clinical Oncology's annual meeting. And Netflix shareholders voted to reject pay packages for the company's leadership, including co-chief executive officers Ted Sarandos and Greg Peters. Now, Sarandos is expected to make as much as $40 million between his salary, bonus, and stock options, while Peters is supposed to make $34.6 million. Netflix's board can disregard the results, though vote is significant given the current strife between major Hollywood studios and screenwriters. And that's your Bloomberg Business Blast. Alex.
All right, Lisa, thanks a lot. It is 23 past 7 on the West Coast. Want to get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its morning. Joining us now, Bloomberg Technology co-host Ed Ludlow back with us. Ed, we missed you. The question mark we all kind of had was Amazon maybe getting into the mobile business and offering services for U.S. Prime members. What?
Yeah, this is very detailed reporting from Scott Moritz, Matt Day, and Spencer Soper. According to sources, they are in talks with Verizon, T-Mobile, and Dish. And the idea, according to those sources, is get access to wholesale rates. Then go to your Prime membership base, offer them a wireless service for $10 a month on top of their $139 a year here in the US on Amazon Prime, or even free. And the market reaction to the upside with Dish, biggest jump at one point since 2011, and to the downside with T-Mobile, I think biggest decline since March of 2020, says how much this could shake up that industry.
Deutsche Telekom getting absolutely battered right now on the back
Europe
of this
as well.
news. Ed, what does Amazon have to say about this?
Yeah, I mean, look, Amazon have issued us a statement through a spokesperson saying we're always exploring adding even more benefits for Prime members, but don't have plans to add wireless at this time. At this time, how much work is that doing? Look, whenever Amazon makes a foray into a new product category, that industry shivers, right, because of its sort of financial clout. The cell phone or wireless network is really interesting. Remember 2014, they brought out Amazon Fire Phone. They killed it after a year. But with Project Kuiper, they are working on space-based internet. They do have a devices history, so it's an interesting marriage, potentially.
Yeah, and it makes sense of why a carrier would want to sell them some space because they got to monetize their 5G. But for Amazon, like, what is it? Is it just to, like, upsell me from the Prime membership of $140 and then charge $150? Like, is that what we're looking at?
Exactly. So, well, there is evidence through third-party data that when they raised the price of Prime from $119 a year to $139, it kind of stagnated. You know, the value proposition was diminished, so you add something new to it alongside video, Prime. But, you know, from the network's perspective, Dish to the upside also interesting because it gives them an opportunity to sell wholesale rate access to 5G networks that everyone is invested really heavily in, but where the utilization is still quite low.
Ed, you're going to be focusing on Apple on Monday, but there seems to be a line between the two. Apple's been very good at creating an ecosystem. If you look at the devices that Amazon sell, the Fire tablet devices, that's a closed world. And I wonder whether or not ultimately that's maybe what they're trying to achieve here too.
Well, we will be live from Apple WWDC on Monday, so tune in for that. I'm looking forward to joining you guys from there. The devices business for Amazon has never been about making money. It's been about bringing people in and bring them in as Prime subscribers through Alexa. That's all it is.
Okay. Ed, we look forward to the coverage. We look forward to the coverage on Monday. We look forward to the coverage as you return with Caroline Hyde on Bloomberg Technology. That is coming up very shortly in around 90 minutes time. We're also going to carry on with our question of the day. Should the Fed now skip June, given the data? Michelle Holder is going to join us next. We're going to talk more about this. This is Bloomberg.
We are about an hour into the U.S. trading session. Here's your takeaway. Just buy all the U.S. things. You got stocks up. You got yields up by as much as 11 basis points. You have the dollar index hitting as high as well. The 5-year is up 11 basis points. 2-year now at 14. Everything's moving higher here. All right, Abigail's tracking the moves. Abigail?
And here's the screen on the screen for stocks, Alex. Take a look at the S&P 500 up 0.9%. Now, the NASDAQ is underperforming today, which is kind of interesting, maybe with those yields higher, but also NVIDIA, the last time I looked, down a little bit, so that's a big weighting to the index. But take a look at the China Tech Index of 3.4%, and the possibility that Beijing will pump some money into the property market there or stabilize things a little bit more. Everybody loves accommodation, or at least investors today. As for one mainly bullish possibility, or tailwind, I should say, for stocks, the non-farm payrolls report. It's interesting because is it good news or is it bad news? This headline number was a good number. It was a massive beat. If we go into the Bloomberg terminal, we can see that. Beneath the surface, though, some of the details a little bit less constructive. So that, in some ways, that should support the idea that maybe the Fed will be on, I think they're calling it a skip for June now, and that maybe back in July. But in any case, there's the 339,000 jobs added relative to the estimate of 195,000 jobs added. And I think this is the 14th straight month of beats. So the jobs market is clearly very firm here in the U.S. Now, this has the S&P 500 higher for a third week. It has the NASDAQ 100 up for a 6th week, the longest winning streak going back to 2021, up 13% over that time period, a lot of it having to do with chips, NVIDIA, and AI. Plus, on the year, if we take a look at these stocks, this is really pretty incredible, Guy. If we see NVIDIA up 172%, its best year since 2016, on the promise of AI and what it could mean. Meta up 127%, its best year ever since having gone public back in 2013. And Apple up, it seems kind of shabby here, but for Apple, the world's largest company, to be up 38% on the year, and it's not even halfway done. This is a big year for big tech.
It certainly is. And you wonder whether that's going to be challenged by the idea that we could see higher rates from here. The bond market, as Alex was saying a moment ago, we're certainly seeing front-end yields moving sharply to the upside, which then begs the question, which is our question, should the Fed skip June? Or should it not? Should it deliver a hike in June? Michelle Holder, John Jay College Associate Professor of Economics, joins us now. Michelle, this is a labour market, and today just again proves the point that continues to confound us all. The Fed has hiked heavily, and the labour market, the unemployment rate, whatever metric you want to use, has continued to be strong. What does the Fed do next? Is the Fed winning this battle?
Well, I think the top line numbers might suggest that perhaps the Fed is not, right? The job creation total was much higher than anticipated. It was expected to come in, just around 200,000. It's over 300,000. So in one way, the Fed may be looking at the numbers and thinking, well, are our measures to tame inflation really taking hold? The job market, the American labor market is still going pretty strong. But if you dig beneath the numbers, number one, the unemployment rate did tick up. And that is partly because the number of unemployed actually increased from the last month, which was a reversal of trends from when the total number of unemployed each month had been declining. So there are signs underneath the top line numbers that might suggest to the Fed that the measures it's taking is working, and perhaps it can skip another rate hike.
Michelle, let's talk about some of the cracks, though. In particular, African-American male employment has been doing really well, and this month it kind of rolled over a little bit. And I'm wondering, does that begin to show cracks in the market? What did you make of it?
Yeah, no, absolutely. It does begin to show cracks. So, in fact, the black unemployment rate ticked up nearly a full percentage point from 4.7 in April, which is a 50-year historic low in terms of the black unemployment rate, to now 5.6 overall. Kind of evenly spread between black men and black women, although the jump for black men's unemployment was slightly higher. That does, from my perspective as a labor economist, suggests that there may be some cracks showing in terms of Fed action. When a recession occurs in this country, the workers, the demographics of workers that are typically impacted first include black workers, Latino workers, younger workers, and those workers with less education.
Let me take the other side of that argument. There are areas of the economy, education is one of them, Michelle, that still aren't back to the levels we saw pre-pandemic. Are there areas that are going to continue to seek employees at an aggressive rate? And is that going to offset other parts of the economy? Rick Reeder of BlackRock was making this point a little bit earlier on. There are still areas of this economy that need more workers and can't find them. How much longer does that persist for?
I mean, I think it's going to go on for a bit longer. So just as an example, the industry that has in some ways really helped lower black unemployment is the transportation and warehousing sector. That sector did add a significant number of jobs in May. So that is one sector that is continuing to grow. And I expect that other sectors like retail trade will come along. Leisure and hospitality has also shown some growth. This is helping the types of demographics of workers I was just talking about. So yeah, the news is not all bad where workers are concerned, but I think simultaneously there are some signs that Fed action is taking hold.
What do you make of the wage number? And what kind of wage growth do you think we need to see to echo a 2% inflation?
Yeah, well, the latest wage growth numbers I think was around 4%, and certainly I would think from the Federal Reserve's perspective, you would want to see that percentage growth rate a little bit lower. So I think it needs to come down a little bit more in order for the Fed to, feel more comfortable that we're getting closer to taming inflation.
Michelle, what's your perspective on what's happening in the manufacturing sector? There has been labor hoarding. You can see it in the numbers. Yet if you look at the ISM manufacturing numbers, they are very weak right now. How much longer do you think that labor hoarding is going to last? Or do you think there is the possibility that actually manufacturing is bottoming out and it's been the right call for those manufacturers to keep those staff?
Yeah, well, manufacturing is one of those industrial sectors that really is sensitive to business cyclicality. And, in looking at the today's jobs report, you'll see that manufacturing was one of those sectors that did not have significant job gains. So I anticipate that sector will probably continue to contract somewhat, but I don't know that it's bottomed out yet.
Michelle, you have also been distinguished senior fellow at the Washington Center for Equitable Growth in D.C. And I'm just wondering, based on all your research, what kind of Federal Reserve policy does the labor market need to see for equitable growth, but not overheating growth?
Absolutely. Well, thank you for that question. This is something that I've talked about quite a bit in the media and in other venues. From what I have been hoping to see from the Fed is I absolutely understand that inflation needs to be brought even lower. The Fed has a dual mandate. Not only is its job to make sure that we have a strong labor market, but also, low inflation. So that's a dual mandate that some may consider conflicting. However, I think that the Fed can achieve that, is trying to achieve that. But what I would like to see is if the Fed is considering further rate hikes, that they are modest and that there is more space in between any further rate hikes, such that they skip this month perhaps.
Michelle, really great. We super appreciate your perspective. Michelle Holder, Associate Professor of Economics over at John Jay College. Thank you so much. All right, coming up, we're going to go to the White House to get their reaction on the jobs data. We're going to go to D.C., where Heather Boushey, a member of President Biden's Council of Economic Advisors, will be joining us next. This is Bloomberg.
Keeping you up to date with news from around the world. Here's the first word. I'm Lisa Mateo. Ukraine's air defense system says 15 cruise missiles and at least 21 drones were shot down in the Kyiv region today. Ukraine's capital has been attacked by Russia from the air on each of the past 6 nights. No casualties were immediately reported after at least 3 people, including a child, were killed in Thursday's barrage. Meanwhile, drone attacks have been reported across a widening portion of Russia. In Singapore, Pentagon Chief Lloyd Austin and his Chinese counterpart, Li Shangfu, are among more than 600 military leaders and policymakers and analysts from 40 nations taking part in the annual Shangri-La Dialogue. The U.S. says Beijing has ruled out a meeting between the 2 military chiefs, with China frustrated the Biden administration hasn't removed sanctions the U.S. placed on Li in 2018. And at least 9 people died in clashes between protesters and police after a Senegalese court sentenced the country's main opposition politician to jail, barring him from taking part in next year's presidential election. The government restricted the use of social media platforms, including Facebook, Twitter, and WhatsApp, in an effort to put a stop to that unrest. Global news 24 hours a day on air and on Bloomberg Originals, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo, and this is Bloomberg. Guy.
Lisa, thank you very much indeed. Let's get back to the main event of today, the jobs data coming in hot, 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 blowing past all expectations. For the 14th time, we continue to be confounded by just how hot the US labor market is. Let's get a read on these numbers from the White House. Joining us as ever, Heather Boushey, a member of the White House Council of Economic Advisors. Heather, thank you very much indeed for taking the time to walk us through your perspective on these numbers. I guess the question that we're all asking right now is, why do we continue to be confounded by this labor market? What is your sense of what is going on here? Why is the labor market still as strong as it is?
Well, this has been an economy that's been able to weather a variety of shocks over the past couple of years, and this labor market has remained strong. The president was very clear at the beginning of the administration that the goal was to, contain the pandemic and get the economy back on track, and we continue to see the fruits of that investment and that hard work to help, families and employers all across the country and communities recover from this recession that we had, and into the kind of economy that has created now 13.1 million jobs since the president took office. This is a great report. It shows a lot of strength in the labor market, and that's certainly benefiting families all across the country.
Hey, Heather, not to pour cold water on it, but the household survey showed a big decline in jobs, and the U3 rate did tick up to 3.7%. What did you make of that? Why?
So a couple of things. First off, as the Council of Economic Advisors stresses every month, we don't make too much of any one-month change. We're always looking at the trends, and we're always trying to put all the different pieces of data together. So the first thing about that number is it's out of sync with other data that we've seen. We've not seen a rise in unemployment insurance claims, for example, just as one data point. So we dug into that number, and what we found is that actually, the payroll survey and the household survey are different surveys, right? So one is a survey of establishments, one is a survey of families, and when you and they have different definitions of what it means to be employed. And when you fix that definition in the household survey so that it better matches that of the establishment survey, you actually find that the numbers are quite similar. And we put that out this morning in, I believe, a Twitter thread to show that. So, when you put all the data together, that number does seem to be an anomaly. Of course, we'll be watching it closely in the months to come.
The guy with the leaf blower always turns up just at the perfect moment, doesn't he?
Yeah, she has like the elements, that or the blinding sun.
We're sorry about that. You did well. Heather, let's talk about you talk about this being the economy that you want. Is it really the economy that you want? Inflation remains a significant tax on the American people. Is the cost of a strong labor market high inflation?
Well, here's the thing. We continue to see this growth in the labor market, and we've continued to see that nominal wages, while they continue to be, growing at a healthy clip, they have come down from their pace over the past couple of years, as has inflation, right? Inflation was over 9% last summer. Now it is, the most recent read, 4.9%. So we are seeing this economy start to, get back to a place that is more sustainable. So I think this report today is yet another indication that we are along that path.
So However, if we have to get to 2%, in your models, what kind of unemployment rate, or a different way of asking it is, what kind of monthly job growth is that consistent with?
Well, we need job growth to be able to keep up with the pace of population growth. And also, one of the things that we've been able to see in this recovery is that not only have jobs grown faster than in previous recoveries, but we're able to make up some of the long-term decline in labor force participation that we've seen in recent decades. We are now back for prime age workers, that is workers ages 25 to 54. They're back to their labor force participation rate of January 2007. That is still not an all-time high. There's still room to grow there. But women in that prime age category, their labor force participation rates are now back to where they had been in 1948 when we started collecting this survey. So there is still some wiggle room, but what we really want to see is that those continued job gains month after month that bring people into the labor force at a pace that is sustainable and accounts for population growth.
Alex was talking about at the top, Goldilocks, immaculate disinflation. There's a number of different kind of ways of pushing this, Heather. Do you think we can get inflation back down to target without unemployment rising significantly from here?
Certainly, the president has made lowering inflation a priority. There are all sorts of steps that he has taken to bring prices down. Now that we've seen easing in some of the high energy prices that we'd seen, of course, last summer, gas prices have come down since then and the like. I think that this kind of report gives us hope that we can see that kind of, quote-unquote soft landing that people have wanted to see. Time will tell, but that is the goal, right? The goal is to make sure that we are delivering for the American people, creating good jobs for folks all around the country while not overheating the economy. And I think reports like this, alongside the reports that inflation has eased and is moving along at least on the right path, that all gives us good indications that we're moving in the right direction.
So Heather, let's get then to the debt ceiling and the reduction that we're going to wind up seeing in the budget for 2024 and 2025. I know the CBO scored it. What are you guys modeling in terms of the growth impact, and where will we see that hit the most?
Well, I think so first off, this is a historic accomplishment, being able to avoid a default of the federal government. The effects of the ability to get this deal cannot be overstated, certainly from the perspective of the U.S. economy. So this is a great day that we are going to be able to move forward and to be able to move past this. And the president is so proud of being able to do this in a bipartisan way, bringing parties together and doing something without having to give up on his priorities. And I think that's where the big questions are, right? He did not have to give up on the priorities that he put in place over the past couple of years, the bipartisan infrastructure law, the CHIPS and Science Act, or the Inflation Reduction Act. And all of those are about investing in the long-term growth potential of the U.S. economy. So we remain optimistic that the kinds of investments that we are making in people and places all across the country that's going to drive productivity and growth that we are seeing, of course, as the private sector is, jumping into the economy and boosting investment, opening up battery plants and electric vehicle plants and the like all across the country, that kind of growth will continue.
At some point, Heather, we are going to get a downturn. And I'm wondering whether or not the deal that has been done is going to limit the fiscal response that will be available when that downturn arrives. Or do these spending caps become kind of arbitrary at that point? Can they be overturned? Do you think they're real? If we get a serious recession in the United States in the next 18 months, do you think this debt deal is going to contain the ability of the federal government to respond to that?
Listen, policymakers, this is what they have to do, right? This is what the role of policymakers is. They have to deal with, whatever comes at them. What we saw during the pandemic and the recovery was Congress came to the table and was able to pass historic legislation to make sure that families and communities and businesses across the country did not needlessly suffer. And this president has shown time and time again that people underestimate his ability to work across the aisle, come to bipartisan compromises that work to the benefit of the American people. So, at this point, I don't have a crystal ball that tells us exactly when we're going to have a recession. Of course, one will happen at some point in the future, but we don't know when. And I think that what it brings me hope, especially today as we were talking about this historic accomplishment with the debt ceiling, is that President Biden will be able to find that path to make sure that we are securing jobs and making America a good place for businesses to invest and to create that vitality across the country.
So to that point, President Biden said back in May that once everything is over here, that they're considering a test case to the Supreme Court on whether the 14th Amendment gives them the power to basically nullify the debt limit. Is that on the table right now?
I think today we are really focused on the historic accomplishment of getting through this immediate crisis.
But Heather, is it on the table tomorrow or Monday?
I'm going to leave that to other folks to weigh in on. I think today we are very much focused on what the president has achieved working with Congress and Republicans in the House.
Would you have a sense of like how fast that could happen? I mean, I understand we want to tout the accomplishment, but if we were to set this in motion, do you have a timeline for that?
I really will leave that to other folks. I think that what I'm focused on today is what this means for the economy right here, right now, and on top of today's strong jobs numbers, I think what we want to see is this kind of labor market continue to perform for the American people.
Oh, I tried so hard. Would you support that though, nullifying the 14th? Or nullifying the debt limit?
Really just focused on the labor market today.
How many times can I ask the same question? Heather, thanks a lot. We really appreciate it. Thanks for playing with us. Heather Boucher, a member of the White House Council of Economic Advisors. This is Bloomberg.
So we're about to wrap up the week here in Europe, and there is much to talk about. Stocks being driven higher by the payroll report, but also by talk of China stimulus. That's having a big effect. The stock 600 up by 1.4%. The miners are leading. There's some single stocks that are worth talking about. There's Rio. That's the mining story, up by 3.7%. But look at Deutsche Telekom. Look at the impact this report that Amazon might be getting into the wireless business is having. DT's got a big exposure, obviously via T-Mobile in the United States. It is getting battered right now on the back of that story. Deutsche Telekom down by 8.61%. Real estate's having an interesting day as well. We're going to talk about SBB in the next hour as well. Its CEO stepping down. Potential deal with Brookfield. Anyway, lots to discuss. James Athey is going to be joining us in the next hour. We need to talk about this payroll report. We need to talk about this China stimulus story. Should you be playing that is a key question. He's an investment director over at Aberdeen. He's going to be joining us next. We need to talk about the payroll story, the China story, the single stock story. We're going to do all that next. This is Bloomberg.
that all day yesterday.
Friday, the 2nd of June, much to talk about here in Europe. Yes, we're watching what's happening with the payroll story. Yes, we are watching what is happening with the DT story. But the big story in many ways today for Europe is what is happening with the China stimulus story. We need to discuss that. Is that a story you should chase? Europe's having a good day on the back of it. Does it last? The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So let's check on these markets. Stock 600 coming through to the end of the week on a high note. Look at that, up by 1.44%. Miners are the big story here. Bottom end of the market, you've now got the telecom sector because of Deutsche Telekom, because of the Amazon story. There's also a property story in here as well. There's much to talk about. We need to talk about China and the effect that it's having, because it's certainly having a big effect on names like Boliden. The copper sector has had a really good day today. So Rio's having a good day as well, which is interesting considering that iron ore is up, but copper's actually rolled over a little bit. Do we believe this stimulus story coming out of China, and is it going to have a market effect, or is it going to fizzle like the previous ones have recently? SVB is another story I want to talk about. This is the Swedish property company that has had so many problems recently with rising rates. And we now know that the CEO is going to be stepping down. I think he's going to be stepping down on the 5th. We also had a story earlier on talking about the fact that Brookfield and others are in early stage talks about the property portfolio that this company has. Look at the reaction. A coiled spring. Obviously, there's probably a lot of shorts in the mix, so there's a bit of a squeeze going on here. But the stock, Alex, is up by 53%. That's
okay,
a big
so
move.
Let's track that over here. So the S&P is up by 1.2%. So a few things going on here. One, Dish outperforming, and that goes to the headline that Amazon's thinking about launching, offering a phone service with Prime membership, bad for T-Mobile, Verizon, potentially good for Dish. So that's one part of it. The other part of it is look at this VIX, under 15. You have to wonder if we're seeing short covering, if there's FOMO coming in after that jobs number, if it is a Goldilocks scenario, right? Selling bonds, buying the dollar, buying stocks. Is that what we're seeing continue to play out? Speaking of, you're looking at a big jump in the front end of the bond market. Lots of selling, particularly in that front end, up by about 12 basis points. But that's not hurting tech. It's not hurting the interest rate sensitive sectors. And speaking of copper, Guy was just mentioning it. This is where we are on the LME, 8,200. We are off the highs. You mentioned the China trade. I also have to wonder how much of it's the dollar index hitting its high in the last hour on that jobs number. But nonetheless, do we see some stabilization in some of these commodities now?
It's interesting, crude's up really strongly today. We're going into OPEC. We'll talk about that a little bit later on in the program as well. Let's talk more, though, about what is happening here in China or there in China. It's having an effect here in Europe. It's having a big effect here in Europe. The question is, should it be? So as Alex was saying, copper was up earlier. That's had a big effect into the mining sector. Some of the copper names in particular are up. The luxury names have had a relatively good day today. The question is the market getting ahead of itself? This is the China property investment story. China's property investment started to pick up over the last few months, but is now fading. They're throwing quite a lot. They're throwing sort of some stimulus at this sector right now. The question is, if they keep doing what they're doing right now, is it really going to have an effect, or is this rally that we're seeing at the moment going to fizzle out? Is the impact of the stimulus, Alex, ultimately going to sort of fizzle out? We've all been anticipating this big China recovery story. And honestly, we keep being disappointed by it in so many ways. And I'm wondering whether this stimulus story is a trap in that same way that the market is setting for itself.
Which is the question of the day. How do you play it? And even the question, do you play the China stimulus? So joining us now, Eddie Vanderbilt of Markets Live, and also Mike McKee joining us. He's doing double duty for us on jobs, and also on China growth. Eddie, I just want to start with you because of the rally that we're seeing in commodities. Do you play the China rally, and should you be playing it through commodities?
This is a really interesting reaction, Alex, because I think, of course, if they stimulate the property sector, that means more building, that means more copper wire, that means, that's good for commodities broadly. But the China story lately hasn't been one of stimulating that kind of growth. China, I think, will be a lot more circumspect about the way that they stimulate unless the consumer gets in trouble. And at the moment, the really, really bad PMIs are all in the manufacturing sector. The non-manufacturing PMIs are still, above 50, even though they are creeping lower and lower. We actually had the biggest split between manufacturing and non-manufacturing PMIs, negative split, since the global financial crisis in April. Now, that's narrowed a little bit, but I think that's because we're seeing the consumer come back a little bit too. And I think that's what the hope is here. I think people are saying, look, if we see China really coming out and really stimulating a broad-based economy, then that's going to be great for the consumer. It's going to be great for demand overall, and then perhaps good also for commodities. But I think European luxury is much more of a beneficiary here than is copper and other commodities.
Yeah, it's interesting that the copper stocks are up as strongly as they are, therefore. Mike, and that's the point here. They're being cautious. They're inching towards stimulus. They're not doing it wholesale because maybe they've learned the lessons of the past. But nevertheless, maybe that's what is required. And we all got very excited this morning about this idea that we were going to be seeing stimulus. But I do wonder, if it's not big, does it fizzle? Is it a trap for investors once again? What is your assessment of the substance and the size of this that the Chinese are potentially talking about?
Well, it doesn't look big, not in comparison with the things that they have done before in the property sector. But remember, China has millions of unoccupied and unfinished apartments in many cities around the country. So it isn't clear that boosting more real estate building will do a lot for the Chinese economy, which may be why they're keeping this stimulus sort of small. But the real issue with the Chinese economy is that people are not spending money in the way that they were expected to when they came out of the pandemic. We've seen retail sales fall off, and nobody wants to borrow, which makes it hard to stimulate an economy, aggregate credit falling. So at this point, the Chinese economy seems to be stuck in sort of a low growth mode, which for them is higher than ours, but it is still much weaker than it has been there. And it's not coming back in the way people thought. And it isn't clear that government stimulus can actually make that happen.
Which raises an interesting point too, because Guy, what the West also had that China didn't in some respects is the Ukraine war, and that really spurred on like shovel-ready projects. Like, we got to put shovels in the ground to do stuff. It's that stuff that requires the aluminum and the copper. In addition then to all the cuts, the checks that were cut that then we go buy LVMH bags. China didn't have that former to do.
But Europe, we haven't done that yet. So I appreciate the demand. Yeah, well, at some point we're going to get there, but we're not there yet. China needs a fix now, and the housing market, I was reading the Bloomberg Intelligence economics piece on this, still sick, still really sick. So Eddie, what kind of scale are we talking about here? If you want to fix the Chinese housing market, if you want to put it back on a stable footing, how much is it going to take?
Yeah, I think China is looking at its property sector the way that the US is looking at its banking sector. It's saying this is something that is potentially systemic, and therefore we've got to keep supporting it and keep it, because if this falls over, the whole of the economy will suffer. But I don't think that they are looking at this as a broad-based stimulus for the economy. I think if they move in that direction, so then in that sense, I think the market is perhaps over-interpreting what we have got today. But I think it just underscores that China is still an economy that likes to stimulate. It's an economy where they like to intervene and keep growth on the path that they wanted. And I think if they do start seeing their non-manufacturing PMIs come down sharply, and we saw a decline this month, if they see that coming down sharply, I think that this is a signal that they will continue to stimulate the broader economy, and maybe even in the way that European and Western economies did with direct checks or something along those lines. But we're not seeing anything like that yet.
That's interesting, Mike, that like the West now is leading when it comes to stimulus. And seriously, like whether you're talking infrastructure stimulus like with the US or whether you're talking about cutting checks, that's like very different than the world that we were used to after the financial crisis.
Well, the Chinese have been stimulating investment for quite some time, particularly in the housing market, but the government has also paid a lot to develop technology, and some of its state-owned companies, and in the energy industry also in particular. But with the U.S. and to similar extent, not quite as much. The Europeans basically did, as Guy described it, sending checks to people during the pandemic, where the Chinese just kind of locked everybody down. And so you have a real caution among Chinese consumers and a desire to keep saving money. And of course, they don't have the safety nets that the U.S. and Europe have. So there's an impetus to save in China that there isn't here. Now, will they stimulate? Probably. Remember, it's a centrally controlled economy that has gotten even more so under Xi Jinping, and their goal is to keep civil unrest down. And we've seen reports of job creation slowing significantly, people with a lot of education unable to get work now, and so that's going to be a real problem for them unless they can get the economy moving again in some areas.
Yeah, I think the lesson from all of this is you don't want the velocity of money to basically hit zero, because then it's really hard to get the engine started again. The Chinese are definitely learning that lesson. Eddie, final point to you. LVMH, no, going to China. Tesla, Musk had just been there. JP Morgan, Diamond just been there. What do you make of that in terms of what that is telling us about how the Chinese are viewing their economy and how important these folks are to that economy?
Yeah. Look, this is clearly still an economy that is very important to them. It's still an economy that that these companies still see as a growth market for them. But I think this is the big worry even for China, is that a lot of companies are pivoting away from China, and they're saying, look, we're seeing India growing really strongly, and we're looking towards that new growth engine, and that's definitely something that we're starting to see emerging at the moment. And I think that's another reason why in China they will want to pivot back to stimulus sooner rather than later, particularly if the consumer starts to struggle.
Yep, we're going to carry on this conversation next. Eddie Vandervolt, Mike McKee. Guys, thanks very much indeed. Coming up, more on our question of the day. Do you play the China stimulus? James Athey, Aberdeen Investment Director, joining us next. This is Bloomberg.
China passed a law in 2021 to start to protect national data. And they've been doing this very quietly, drip, drip, drip. But they have restricted foreign access to parts of this database, which you really need to understand China. Now this month, they're putting personal data restrictions into place. You need new alternative sources of data to understand China. And also, is the risk premium to invest in China getting so high because you don't have the tools to do the analysis anymore that it's going to make China harder to invest in?
Yeah.
Rebecca Patterson, former Chief Investment Strategist at Bridgewater Associates, speaking to Alex and I yesterday, Alex and me yesterday, and that takes us back to our question of the day. Do you play the China stimulus story? We got very excited first thing this morning with this idea that maybe the Chinese are going to deliver some stimulus, particularly stimulus that is designed to lift the housing sector. Copper rallied. The mining stocks got very excited. The luxury sector bounced back a little bit. But to Rebecca's point, do we understand what is happening here? Is this an investable story? James Athey, Aberdeen Investment Director, joining us now. James, what do you make of this China stimulus story? Everybody got excited. It feels like muscle memory. In the past, China stimulated, it did it in size, and it had a meaningful impact. Is that what we're really seeing here?
No, I don't think so at all. I mean, I agree with Eddie previously that the Chinese probably looking at the property sector as more of a downside risk than an engine for growth. The rhetoric from President Xi has not really changed. Properties are for living in, not speculating in, and there's still a massive overhang in terms of residential properties and the damage it's done to developers, which has the potential to sort of spiral in the opposite direction if it isn't managed. So I think the Chinese are trying to draw a line under a risk here rather than drive growth forward.
Okay, fair enough. So it reminds me of weirdly OPEC. Like you're just trying to find a bottom, prevent the fallout, but you're not actually like boosting for growth, for example. So as an investor, like, do you play that at all?
No, I wouldn't, and I haven't. I've been opposed to, and again, this is very similar to what Eddie was describing previously, where potentially trading LVMH, it makes some sense because there is a reopening consumer-driven trade, although that's already fizzling, it would seem. And again, Mike talked about the high structural growth rate, and that's one of the biggest structural issues that the Chinese need to deal with if they want to drive consumption. But this is not 2015-16 stimulus. This is not 2007-8-9 stimulus. This is not something that's going to see massive demand for commodities, given the starting point is obviously very high demand from China for some of these industrial commodities in recent years. So again, I don't think China wants to go back to debt-driven, unproductive infrastructure and residential investment to drive growth, because ultimately that is one of the problems that they face at the moment, is this massive debt overhang that has largely been invested in things which are not necessarily productive and are not driving growth on an ongoing basis, which is ultimately the name of the game.
We can debate whether or not an LVMH handbag is a productive use for economic spending another day, but let's use the example of
Have you looked at the resale? I mean, this is a whole different segment.
Okay,
but come on now.
That's a whole different story. But I guess the point that Alex, I guess the point that maybe I want to go back to the thing that Rebecca Patterson was talking about just now. Do we understand China enough actually to make educated and informed decisions about the effect that it's going to have? And I think the LVMH handbag is a really kind of interesting case in point. We don't have the data. We don't have as much data as we did on the Chinese economy. So now we're looking for the impact that stimulus has in Europe. It's like dark matter. You don't know it exists, but you can see the effect of it on other things.
Yeah.
Is the LVMH handbag the other thing?
Yeah, well, but James, to that point, I feel like for a while it's always like, well, do you trust the data? Do you trust the data? But then the idea that the data is becoming even more constricted, and not even that, but you just can't operate as an investor, operate in China or have the visibility to actually make an investment. And I can imagine how much more difficult it is if you're a CEO trying to do business there. James, what do you think about that idea?
Yeah, I mean, obviously the data has been an issue. Always there have long been question marks around the data. I think largely the data sort of uncertainty can be solved by the idea that it's smoothed over time. Therefore, it's not necessarily understated through time, but any given period there might be some smoothing effect. But I'm a macro guy, and so I'm going to take an even bigger picture view of China here. This doesn't necessarily help me invest in LVMH or not, but if you think of an economy like a bucket, and growth is a flow of water, and ultimately the name of the game is to try and fill your bucket as full as possible. If the bucket has holes in it, you can increase the rate at which you pour water in, but ultimately, as soon as you stop pouring water, the bucket will start to empty again. And that's the idea about structural policy. Structural policy is fixing the holes in the bucket, and fiscal policy and monetary policy are increasing the rate at which you pour water into the bucket. China has holes in its bucket, and it knows that it's not going to fix those by simply throwing more money at the problem. And of course, debt needs servicing. And if you choose to use debt to try and solve your problems in the short term, you just create bigger problems in the long term. And that, for me, is the story of China at the moment.
Okay, let's take the next step in that. The beneficiary of that bucket leaking, to a certain extent, has been Europe. And I'm wondering, if we do see China stimulating at this point, if the right way to play it, therefore, is Europe. If the bucket is leaking and it's raining in Europe, isn't that the place to play it rather than playing it in China?
Well, no, again, the form of stimulus matters, obviously. So what China has been trying to do is rotate the economy to something that's more Western-esque, more focused on consumption. You know, consumption is not an evil. That there is this value attached to production versus consumption. Production in and of itself is not virtuous. We produce so that we can consume. Ultimately, the end goal is always consumption. China hasn't consumed enough, given the size of its population, because as Mike noted, it's got a huge savings rate, and I think that does relate to one-child policy and the lack of a social safety net. But what has happened in China in the last 20 or 30 years is you've had this increasingly large, wealthy middle or upper class who have been engaged in conspicuous consumption. That's been good for luxury goods. On the other side, you've had China stimulating the sort of heavy industry infrastructure investment. That's been great for German heavy machinery exporters. I don't think either of those is necessarily expected to grow rapidly from this starting point, and I think that's maybe a headwind for Europe through both channels.
What about for the U.S.?
Yeah, obviously the flow is largely in the other direction. The US generally has been a consumer of China-produced goods. There's not necessarily been a lot that's going in the other direction. The reality is that Chinese potential growth is probably a lot lower than the rates of growth that we've been used to. And ultimately, that's going to weigh on the global economy in general. And I think you can see that in Chinese prices. PPI is negative, CPI is zero, expected to be negative very soon. I think we could quite easily be back to a world where China is exporting disinflation. The US has largely been the world's consumer of last resort, and we can see in recent data that largely the consumer is holding up, but it's doing so via services, more parochial, more domestically focused, and so that's another engine of growth. So in that respect, I think China and the US are more likely to feed off each other in a negative fashion over the next 12 or 18 months.
Interesting, which may not be the worst thing if we're going to export some disinflation. Like maybe the Fed likes that. Maybe it helps to some extent. James, we appreciate it. Thank you so much for joining us, and thank you for saying that consumption is not an evil. I appreciate this. James Athey, Aberdeen Investment Director, talking my book. All right, this is Bloomberg.